Over leverage. We saw this with Rusco. Thousands paid Rusco and never got the service for the money they put down. We are entering a point in the economy where we will see a deleveraging due to risky collateral, asset deflation, a possible liquidity crisis, and huge credit contraction. That makes accessing assets equity or creating new equity more difficult. Imagine a developer of a huge apartment building. If it's built already, then many refinances are getting denied. If the new construction hasn't started, the banks may also deny that opportunity to develop. The banks, especially the regional banks, seem to be in trouble these days. For those too tightly tied into their story of success, they may be too zoomed in into finite options. But when they zoom out and let go more from their identity, they receive more options, more insights, more ideas. They feel more creative. Cash on cash return with low to no leverage internally allows you to grow at a pace that is in alignment, a calm, relaxed feeling, even when the economy shows us a tsunami. If your cash on cash return is non-existent, the cash flow doesn't fully factor in vacancy, skyrocketing inflation on insurance, property taxes, inflation on labor and maintenance, super high interest rates, which we're seeing, many banks denying a credit expansion, which allowed many businesses a chance to grow a lot since 2012. In that case, then you will be very dependent on physical circumstances. And how can I control them? The overnight repo rate spike on September 17th, 2019, from around 2% to as high as 10%, was within hours, was caused by a combination of a temporary cash shortage in the financial system and overall low level of bank reserves. Some think it was based on trust and collateral. That's just what some think. That overnight part, I got off a quick Google search. I do remember that day, though. The COVID shutdown shortly followed that. Due to this economy, we are going to see some amazing opportunities for real estate investors. With motivated sellers out there who can't access credit easily and are running out of options, we know that many will be forced to liquidate for cheap, for a lower cash offer, or sell for more on seller financing on amazing terms. I'm talking as low as 0 down and 0% interest rate with a 10-year balloon, just to, get someone to take over payments. We are talking about a two-sided marketplace here, haves and wants. Just like you see at the first Tuesday night at 7 p.m. at MNREIA, where motivated sellers and wholesalers have the mic and a big cash buyers list ready to listen. Maybe the cash is hard to access money right now, but with the right numbers, investor buyers are looking to multiply and compound their cash flow, and they eagerly show up looking for that deal. I'll leave a link for you for a free pass to your first time attending MNREIA for that first Tuesday night at 7 p.m. for the haves and wants. Options exist on both sides. Be creative. Be open-minded. Remember, when you raise your consciousness, you raise your money and options potential. The AI bubble out there is interesting. On another note, I do think that that AI bubble leads to more motivated sellers and deflation of asset bubbles, which are more opportunities to buy from motivated sellers in the future. Let me share an AI video based on a Google search of how circular financing backfires in the AI technology space. Check this out right now. I just want to add a little bit of clarity to that last video that I just did. Although cash is king and cash can be harder to access during a liquidity crisis, the right investor buyers who do show up with the right numbers would have access to hard money, which would be able to buy like cash to do flip property short term and so forth.
Circular financing can backfire by creating artificial revenue and demand, increasing systemic risk across interconnected companies, and leading to a potential market bubble and subsequent collapse when the underlying business fundamentals fail to support the inflated valuations. Key ways circular financing backfires include artificial revenue inflation. Companies may invest in each other, and the recipient company then uses that capital to buy goods or services from the original investor. This makes it appear as though the companies have strong, growing revenue, but the money is simply changing hands within a closed system rather than coming from genuine end market demand. Systemic and concentration risk. The web of mutual dependencies means the failure of one major player can trigger a cascade of failures throughout the entire ecosystem, leading to massive losses across the market. This is a form of concentration risk where a large number of companies are tied to the fortunes of a few central entities. Hidden exposure and off-balance sheet risks. The complexity of these arrangements can obscure the true financial health of the companies involved, making it difficult for investors to conduct proper due diligence. Inadequate disclosure of customer concentration and related party transactions contributes to this lack of transparency. Unsustainable valuations, bubbles. The inflated revenue figures can trick investors into overvaluing company stocks and lending them too much money, creating a speculative bubble. This is similar to the dot-com bubble's vendor financing practices, where telecom equipment vendors lent money to startups to buy their gear. Massive losses. When the bubble bursts, when the true lack of organic, profitable demand becomes clear and new capital inflows cease, the bubble can burst, leading to a rapid and significant drop in stock prices and market value. Companies that fail to generate sufficient revenue to repay their debts are forced to default, leading to write-offs for lenders and potentially bankruptcy. Accounting irregularities. The pressure to sustain the growth narrative can lead to aggressive or manipulative accounting practices, such as channel stuffing or improper reserve manipulation, which further destroy investor confidence when audit scrutiny intensifies.